Right now, your brain is doing exactly what nature trained it to do in the wild, not in a modern market. It chases motion, reacts to sudden alarms, grabs at what looks scarce, and lets go of what feels uncertain. That pattern kept our ancestors alive, but in trading, it pulls you into tops, shakes you out at lows, and leaves you with a story about bad luck instead of a method. If you have ever watched a candle sprint and felt your pulse sprint with it, if you have ever closed a winner too early because a small pullback felt like danger, or if you have doubled down on a loser because giving up felt like failure, you have seen the old program run on new hardware. Here is the promise. You will build a rule-based approach that makes sound choices even when your feelings are loud. Your risk on any single trade will be capped at 1% or less. Your setups will pass a clear filter before you act. Your judgment of your edge will be based on a sample of at least 10 trades rather than one dramatic outcome. Your exits will be planned before entry so you do not negotiate with the screen after you are inside the position. Your decisions will be gated by a short checklist so that you can act in under 3 calm seconds or you can pass without regret. You may have tried rules before and slipped back into impulse. The fast alarm circuit in the brain fires first and it will always fire. What changes with training is what you do next. It becomes a signal to pause, breathe, scan your state, and return to your plan. You will notice the pull of crowd stories and news spikes, but instead of following the rush, you will ask one useful question. Does this fit my playbook? If yes, proceed by rule. If no, let it go and protect your attention for the next clean setup. Across this program, you will learn simple tools to calm the body, score your emotions, and convert rough intuition into measurable criteria. You will learn a 5-layer entry screen that forces you to respect structure, confluence, momentum, risk-reward math, and emotional clearance. You will adopt a position sizing rule that keeps you in the game during losing streaks and lets your best trades speak with size when the odds line up. You will track your compliance so you can judge your behavior, not your feelings, and you will iterate rules like an engineer rather than rewrite everything after each loss. By the end of this journey, you will carry a simple identity. You are not a hunter of thrills. You are an operator who runs a process. You will still feel excitement, disappointment, and the urge to chase. You will stop letting those feelings run the account. You will know your maximum daily loss in advance and respect it. You will close the platform when your plan says the session is done. That discipline will not make you a robot. It will make you consistent, and consistency is what compounds over months and years into the results you came here to build. You are about to meet the patterns that make perfectly smart traders do perfectly dumb things, and the first one is the vertical mirage. A candle rockets and your eyes lock on it as if it were a flare in a dark field. The reflex says jump now or miss it forever. You click late, price stalls, the pullback you did not measure knocks you out, and you watch the chart drift in the original direction without you. The damage is small per trade but repeats often and erodes confidence. The upgraded behavior is simple. Mark the level that was broken, wait for price to retest or build a short base, and only act if your entry gives you a defined stop and at least 2-to-1 reward to risk. On Ether during a fast morning session, instead of chasing a 1-minute spike at the top of the impulse, you let the first pullback touch the breakout zone, you place your stop one structure below, you size at 1% risk, and you accept a missed move as the fee for clean entries. Next comes the newsquake chaser. A headline hits, spreads widen, candles stretch, and the crowd pours in with zero reference point. The reflex is to buy strength or sell weakness without a plan because it feels like the market is revealing a secret in real time. The damage is slippage, random stops, and account churn when the first counter move appears. The upgraded behavior is a clock and a map. If a scheduled release is coming, you pre-decide to stand aside for the first 1 or 2 5-minute bars, then trade only if the move aligns with your higher timeframe structure and gives a retrace entry with measured risk. On a day when inflation data drops and the index futures lurch upward, you let 2 5-minute bars print, you confirm that the push breaks a weekly supply shelf, then you take the first higher low with a stop below the pivot and partials at fixed multiples while leaving a runner only if the trend confirms. The social mirror is quieter but just as costly. An influencer posts a confident take, a chat room erupts, your feed fills with snapshots of green positions, and your brain borrows their conviction. The reflex is to enter because they sound certain and because being left out feels like being wrong. The damage is obedience to someone else's rules, which means you are unprepared when the trade needs management. The upgraded behavior is sovereignty. You can note ideas from others, but you act only when the setup passes your own filter and fits your playbook. On a small cap stock that a large account highlights, you pull the daily chart, see that price is ramming into a weekly supply with no base, and you skip. On a different day, an altcoin is flagged by a popular thread, you check your structure map, see a fresh higher low above reclaimed support, you take it with 1% risk and a pre-written exit plan, and you ignore the thread after entry. The vengeance driver is the part of you that insists the market owes you. After a loss, you feel a restless heat and you want to get it back now. The reflex is to take a new trade quickly, in larger size, or in a random product, sometimes the very next candle. The damage is cluster losses, blown daily limits, and the story that today is cursed. The upgraded behavior is a hard pause and a ritual. When a stop is hit, you stand up, breathe for 1 minute, rate your emotional charge on a simple scale, and review the plan for the session. If your charge is high, you reduce size by half or you stop for the day, and you write 1 sentence about the lesson you just paid for. On a volatile pair like pound-yen, you take a planned stop, your charge reads 8 of 10, you close the platform and move to a debrief, and you come back the next session with the same system instead of rewriting your identity overnight. The exit ghost is the fear that any green will vanish, so you bargain with the trade at the first flicker of red. The reflex is to take small wins and let losses breathe, which inverts the math. The damage is a long sequence of tiny gains erased by a few full stops, plus the training of a habit that teaches the brain to grab and run. The upgraded behavior is pre-commitment. Before entry, you define partial takes, a trail method, and the explicit conditions that invalidate the idea. You accept that a good trade can come back to entry before it moves to targets, and you let that process happen because your stop was chosen with intent. On a large cap, you buy a pullback into a daily demand zone, you set a first partial at 1 times risk, a second at 2, and a trail under higher lows only after the second target fills. When price wobbles early, you do nothing, because your plan is already on paper. These archetypes share a root. An alarm circuit fires and pulls you toward action that feels urgent and away from rules that feel slow. You will not silence that alarm because it was built to keep you safe. You will use it as a bell to begin your process. When you feel the vertical mirage, you switch to retest logic. When a newsquake erupts, you let the dust settle and read structure. When a feed screams buy now, you open your own filter and ask whether the idea survives your criteria. When loss stings and a second trade calls, you measure your emotional charge and engage the pause. When green appears and fear whispers take it, you follow the exit map that was written before the first click. Each time you do this, you wire a different association. Urgency becomes a cue to slow down. Hype becomes a cue to check alignment. Pain becomes a cue to reduce and recover. Over weeks, the account starts to reflect a new identity. Fewer random entries, cleaner stops, steadier outcomes, and a mind that can wait for its pitch because it knows there will be another. Your trading screen tugs on 2 old control systems in the brain. One is the fast alarm circuit that reacts in a heartbeat to any shift that could matter. It scans for danger and opportunity, narrows your vision, lifts urgency in the body, and pushes you towards simple moves like grab or run. The other is the deliberate circuit that holds a plan, compares options, and keeps a rule alive even when feelings surge. In markets, the fast circuit always fires first. You see a tall candle and your fingers hover over the buy key before you have mapped risk. You see a small red flicker against your open profit, and your mouse drifts toward close because a tiny loss feels safer than waiting for the plan. Nothing is wrong with you when this happens. The system is doing what it was designed to do. The skill is learning how to route the burst from fast to slow before you act. Selection is the art of feeding the slower system at the exact moment the fast one shouts. Small physical actions make a real difference. Plant your feet, release the jaw, drop the shoulders, and slow the breath. Speak the rule you intend to follow in a plain sentence. These moves send a calm signal up the chain and reopen evaluation. You are not trying to erase emotion. You are putting a frame around it so it stops steering the hand. When the eyes widen at a burst of motion, you ask your one useful question: does this setup meet my playbook? If yes, you proceed by rule. If no, you let it pass and keep attention for the next clean chance. A second driver is the reward engine. When price surges, the brain predicts a payoff that might be near. The mark of reward prediction rises, attention glues to motion, and the mind starts to picture the win before you have earned it. If you chase and the move extends, the brain records that chase as success, and the loop strengthens. If you chase and the move snaps back, the brain records pain and you overcorrect on the next trade by becoming timid at the worst time. You can retrain this engine by pairing reward with process rather than outcome. You log a small win only when a trade followed the entry filter, honored the stop, and managed exits by plan. You log a neutral or even positive note when a clean pass saved you from a marginal setup. Over weeks, the brain begins to release a small sense of reward when you wait for A+ conditions and a small sting when you violate your rules, which is exactly the wiring you want. Stress chemistry adds a third layer. Under pressure, the stress hormone climbs, breathing turns shallow, and the field of view shrinks. Small pullbacks look like danger. Loud headlines sound like signal. The deliberate circuit loses fuel and execution quality falls. This is why breath drills and short resets are not soft ideas. 1 minute of 4-count inhale and 4-count exhale can lower arousal enough to widen perspective. A quick body scan that notices jaw, shoulders, and hands can release tension and return fine motor control. Moving the eyes from the center of the screen to the edges and back can widen visual attention and cool the tunnel effect that feeds impulsive clicks. None of this takes long. It is a short bridge back to the part of you that can think. Training ties biology to rules. You rehearse the pause after the first spike until it is automatic. You run a 3-second checklist so your eyes search for the same facts in the same order every time. You say the entry, the stop, and the targets before you click so the plan sits at the front of working memory. You score your emotional charge on a simple scale and let that score reduce size or end the session. With repetition, the fast alarm still fires, but now it summons the deliberate system instead of drowning it. The rush becomes a bell that starts your process. The calm actions you practice become a reflex as quick as the impulse they are meant to direct. This is how normal human wiring starts to serve a trading plan instead of sabotaging it. Recency bias makes the last move feel like the next move. After a sharp rally, you assume strength will continue and you buy late. After a sharp drop, you assume more pain and you sell into exhaustion. The corrective move is to anchor decisions to the higher time frame map and to your entry checklist. If the structure and confluence are not present, you pass even if the last candle screams. Confirmation bias filters evidence so that only the facts that support your idea feel true. You decide on a long and then you hunt for signals that agree with you while you ignore fresh supply overhead. The fix is to write a simple pre-trade test that asks what would prove this idea wrong and to search for that first. If the disconfirming fact is real, you stand down. Herd mentality substitutes social certainty for your own rules. A room piles into a name and the energy feels like safety. Your protection is sovereignty. You can consider outside ideas, but you act only when the setup passes your filter and your risk can be defined. Loss aversion makes a small certain loss feel worse than a possible larger loss. You move the stop or remove it and hope to feel better later. The cure is pre-commitment. Place the stop at a logical structure level and accept the 1% hit as the price of doing business. Anchoring ties you to an old reference point even after conditions change. You cling to a target set in a different regime or to a thesis formed before a level broke. The fix is routine updating. When structure shifts, you refresh the plan and you let the old anchor go. Overconfidence appears after a streak. You feel sharp and you loosen rules or raise size without data. The antidote is a compliance score and a rule that cuts size after a run of wins. Gambler fallacy tells you that a win is due after losses or that a loss is due after wins. You base the next click on sequence rather than edge. The correction is to treat each trade as independent and to execute only when the playbook criteria are met with at least 2-to-1 reward to risk. Scarcity thinking tells you that this is the last train and you must jump, but markets are a river, not a single bus stop. Opportunity flows through every week of the year. The job is not to catch everything. The job is to filter for the few clean chances that fit your edge and to let the rest pass without a tug on your attention. Start each day with a short morning abundance reset. Sit up straight, breathe with a slow count, and read a one-line mission to yourself. I make only planned decisions that match my playbook. Name 3 signs of plenty in the market today, such as multiple instruments in trend, clear levels on a higher time frame, or a calendar with events you can avoid or use. Visualize passing on a flashy but unqualified move and feeling no regret. Then picture taking one clean setup all the way to targets by rule. Close the ritual by speaking your risk limit for the day and the time you will stop. Adopt the 10-trade sample rule so your brain stops judging a method on a single outcome. Commit to run ideas in blocks of 10 with no rule changes mid-block. Log the entry reason, the stop, the planned targets, the emotion score, and whether you executed as written. At the end of each block, review the set. Keep or refine a rule based on the whole sample, not on the most dramatic win or loss. This trains you to think in expected value rather than in stories. Tighten your circle of competence and protect it. Define the instruments, time frames, and 2 or 3 patterns you actually read well. If an idea sits outside that circle, label it interesting and pass. Build a watch list that lives inside your circle and set specific windows when you hunt. Inside the circle, you can act fast with clarity. Outside it, you are borrowing beliefs and increasing noise. Tie all of this to simple math. Require at least 2-to-1 reward to risk on entries that pass your filter. Accept that a method with a win rate near 40% can still compound if losses are capped and winners are let run by plan. When you stop chasing scarcity and start selecting by rules, the game slows down, your diary fills with cleaner decisions, and the account begins to reflect patience rather than pressure. When pressure rises, you will use simple body-led actions to steer the mind back to rules. Start with the 4-count box breath. Sit tall with feet grounded. Inhale through the nose for a slow count of 4, hold for 4, exhale through the nose for 4, hold for 4, then repeat for 1 minute. Keep the tongue relaxed and the jaw loose. As the breath smooths out, the heart slows, the field of view widens, and the urge to click fades just enough for judgment to return. Pair the breath with a quiet sentence spoken out loud. I will act only by my checklist. Hearing your own voice anchors the plan. Add the stop protocol as your first response when emotion spikes. You literally stop your hand, take stock of body signals like heat in the face or tension in the shoulders, observe options that include pass, smaller size, or full entry only if the setup meets criteria, and then proceed by rule rather than by feeling. Picture your mouse hand resting on the desk while you say the next action. I check structure. I check confluence. I check momentum. I check risk to reward. I check my emotional clearance. When each check is present, you move. When any check is missing, you pass. This turns an inner swirl into a short, repeatable gait. Use a 60-second body scan whenever you notice tunnel vision. Start at the top of the head and move attention downward. Soften the forehead, release the eyes, unclench the jaw, drop the shoulders, loosen the grip, and feel both feet on the floor. Let the breath stay slow as you scan. When you reach the hands, shake out the fingers and return to the screen with wider awareness. If you need a fast reset, look away from the center of the monitor and trace the edges of the bezel with your eyes. Then look to a distant point in the room, then back to the chart. This breaks the visual tunnel that feeds urgency. The 17-second reset is a micro break you can execute between candles. Close your eyes or soften your gaze. Take one smooth inhale, then count a slow 7 as you exhale. Hold the empty space for 3, inhale for 7, and sit for a heartbeat before opening your eyes. That tiny pause often makes the difference between a chase and a clean entry. Cold exposure can be a useful practice when done safely and away from the screen. If you choose to train it, keep it brief, warm up first, avoid breath holds underwater, and stop if you feel lightheaded. The purpose is not bravado. The purpose is to learn that you can feel a strong signal and still choose your response. You carry that lesson back to the desk. Quantify your inner state so it can guide risk. Before a session and after any stop, rate your emotional charge from 0 to 10 and your decision clarity from 0 to 10. When charge reads high or clarity reads low, you cut size or you stand down. Write the numbers in your journal so the rule becomes real. Over time, you will notice that trades taken with low charge and high clarity produce steadier outcomes, and that awareness will reinforce the habit of pausing before you act. With breath, stop protocol, scan, micro reset, and state scores working together, the fast alarm in your biology becomes a cue to begin the process that protects your account. Your system begins with the entry screen, because a clean entry is a protective shield around everything that follows. You will view any potential trade through 5 lenses in the same order every time so the brain can settle into a rhythm. First, you map structure. You mark the swing highs and lows that define trend, the levels where price is turned with force, and the zones where trapped traders likely sit. You want the idea to agree with a clear higher timeframe context. If the bigger map says trend is up, you prefer longs from reclaimed support. If the bigger map says range, you favor fades near the edges with obvious invalidation. Second, you look for confluence. You stack 2 or 3 independent reasons for price to move from your chosen area. A level and a retest, a moving average that the market respects on this instrument and time frame, a prior value area, or a volume shelf are examples. Third, you check momentum. You do not need a complicated indicator. You want evidence that the side you plan to join is winning the tug of war right now. That can be a shift in market structure with higher lows for longs or lower highs for shorts, a decisive break and hold above or below a level, or a series of closes that respects your bias. Fourth, you run the reward to risk math. You measure the distance from entry to a logical protective stop that sits beyond structure and not just a few ticks under your entry. You map the realistic path to targets and you require at least 2-to-1 reward to risk before you are allowed to click. Fifth, you clear your emotional state. You take one breath, you rate your charge, and if you are agitated, you either pass or reduce size. The 5 lenses end in a simple verdict. If all are aligned, you may take the trade. If any lens fails, you pass without debate. Exits are designed before entry, so you are never bargaining with a moving screen. You will use a 3-step plan that feels boring but works because it sets expectations. A first target sits near 1 times your initial risk to pay for part of the position and to remove the fear that turns early pullbacks into panic. A second target sits near 2 times risk because that is the minimum ratio that makes a method compound with a modest win rate. The remainder is a runner that stays alive only if the structure continues to confirm your idea. The trail for the runner moves under higher lows in an uptrend or above lower highs in a downtrend. If structure flips against you and your invalidation condition appears, you stop the rest without hesitation. You also define the cancel rules that end a trade that never triggered. If price breaks your level and fails to retest within a defined window, or if the market changes character due to an event, you cancel the order and reset your attention. You treat partials as decisions your past self already made. When price tags the first target, you take it. When it tags the second, you take it. You do not invent new rules in the heat of the moment. Sizing is the lever that keeps you in the game. You cap risk on each trade at 1% of equity or less, so a short streak of losses cannot harm the account beyond your tolerance. You compute position size from the stop distance rather than from feeling. You measure the number of points, pips, or dollars from your planned entry to the protective stop. You divide your 1% risk by that distance to get a share or contract count that fits the plan. When markets are highly correlated, you cut risk further. If you hold a tech name and plan to add an index future that moves with the same theme, you treat them as one risk cluster and split your allowance across them. After a run of wins, you resist the urge to jump size. You can add a small step up only when your tracker shows strong compliance and your method passes a sample review. The partial Kelly idea is a reminder to size for long survival rather than for maximum short-term growth. You want a curve that bends slowly upward and never blows a fuse. The tracker is where process becomes data. You will log each trade with the same fields so you can see patterns that your memory hides. Record the instrument, the time frame, the exact setup from your playbook, the structure context, the confluence elements, and a simple momentum note. Log planned entry, protective stop, and targets at the moment you commit. Score your emotion and clarity before entry on a scale of 0 to 10. After the trade ends, record outcome in risk units rather than dollars, note whether you followed the rules, and add one line about the lesson. Once a week, sort trades by setup and by compliance and let the data tell you where to prune and where to double down. The tracker is your mirror. If the method is sound but compliance is poor, you double down on routine and state control. If compliance is solid but a setup loses across samples, you refine or remove it. To make this real, walk through a momentum pullback example in a trending market. The daily chart on a large cap shows a clear series of higher highs and higher lows. Price is pulled back into a prior breakout zone and prints a higher low on the 2-hour chart. Structure supports along. Confluence appears as a retest of the breakout zone, a moving average that the stock has respected on prior swings, and a small bullish engulfing candle at the level. Momentum shifts as intraday lower highs break and price holds above the retest. The math reads clean. The stop sits one structure below the swing low, the first target sits at 1 times risk in the body of the prior range, and the second target sits near the recent high for about 2 times risk. You take a breath, rate your charge as 3 of 10 and clarity as 8 of 10. You enter on the first micro pullback after the shift. First partial hits and pays for exposure. Second partial hits and locks 2 times risk. The runner trails under each higher low until the trend stutters and the trail is hit. The tracker logs a full compliance trade and the debrief notes that the higher timeframe context did the heavy lifting. Now consider a news-driven spike that you do not chase. An index future surges on a headline during the pre-market. Your higher timeframe map shows a wide range with overhead supply not far above. Structure is unclear for a trend continuation. Confluence is thin because the move is raw and there is no retest yet. Momentum is strong but not anchored to a level. The math is poor because the stop would need to sit far below to avoid noise, which crushes reward to risk. Emotional charge is high because the move looks dramatic. The 5 lenses say pass. You let 2 5-minute bars print after the open. The spike fails at the range supply and the product returns inside value. There is no clean long. You saved a loss by following the screen and not the rush. The tracker logs a deliberate pass with a positive note because protecting attention is part of the job. A third scenario shows a clean short after a broken level. A crypto pair has been grinding up in a channel on the 4-hour chart. It breaks down on rising volume and retests the underside of the channel and a prior support that now acts as resistance. Structure favors shorts below the retest. Confluence includes the underside test, a cluster of prior wicks at the level, and a momentum shift as the retest stalls and lower highs print. The math offers more than 2-to-1 reward to risk to the next demand zone marked on the map. Your emotional score is calm after a break. You take the short on the failure of the retest with a stop above the lower high that defines your invalidation. Price moves to the first target and you reduce risk. The second target fills near the demand zone. The runner trails above lower highs and exits when the trend hesitates and breaks the trail. The debrief notes that waiting for the retest improved the entry and reduced noise. Your system also defines when to stand aside even after a sequence of failed attempts to break a level in your direction. On a currency pair, you map a range with messy wicks and mixed signals. Structure is sideways. Confluence keeps canceling out because one tool says buy and another says sell. Momentum flips every hour. The math offers 1-to-1 at best because stops must be wide to survive noise. Your emotional score rises as boredom tempts you to force a trade. The correct move is to save risk and time for a cleaner market. You close the platform for that instrument and move to a different watchlist item. You do not owe the market a trade. A final rule anchors everything. Before you click, you must be able to say the plan out loud in one sentence. For example, buy the retest of reclaimed support with a stop one structure below and partials at 1 and 2 times risk with a trail under higher lows. If you cannot say it simply, you do not take it. This sentence test prevents vague entries, vague stops, and vague exits. It makes the next minutes predictable. Targets fill, or stops fill, or trails are hit. You record which, and you move on. Over time, the 5-lens entry, the pre-planned exits, the position sizing math, and the tracker turn trading from a string of emotional events into a chain of decisions that can be audited and improved. That is the heart of an offensive system. It does not mean more trades. It means better trades that obey a plan, protect capital on the downside, and allow the upside to express itself when conditions are genuinely aligned. Your edge lives in what you do before and after the trade, more than in the moments you are inside it, so you will treat routine as part of the system rather than as a nice-to-have. Begin each morning with a short priming sequence that clears noise and sets a narrow mission. Sit up straight with both feet grounded, breathe slowly for 1 minute, and read your mission line out loud. I will only take planned trades that match my playbook and risk limits. Open your higher time frame charts first and sketch the map by hand or with clean levels so your eyes see the same structure throughout the session. Mark the major swing high and swing low, the nearest supply and demand, and any level that rejected price with force in recent days. Check the economic calendar and write a single sentence about what you will avoid and what you will allow. If a high-impact release is scheduled during your usual entry window, you either plan to stand aside for the first 2 5-minute bars or you restrict yourself to retests that give defined risk. Define your daily risk cap and your stop time in plain numbers. For example, I stop trading at 2 full risk units down or when the clock hits noon. Review your watch list and remove names that sit in the middle of messy ranges so you protect attention for clean structure. Spend 90 seconds rehearsing your entry filter by speaking it aloud as if you were teaching it to a new trader. Structure first, then confluence, then momentum, then math, then emotional clearance. This simple rehearsal reminds your hands what your rules feel like and makes it more likely you will notice them when the screen moves. Carry this preparation into the session with a minimum interface. Fewer indicators, fewer flashing sources, and a set of chart layouts that you never change on the fly. Keep notes in a simple diary window on the side where you can type quick state checks and observations without leaving the platform. When nothing meets criteria, stay with the plan and do productive waiting. Scan your prepared names on a timer, hydrate, and stand up for a brief reset every 30 to 45 minutes so the body does not push you into action just to relieve restlessness. When a setup appears, speak the one-sentence plan before you click. Buy the retest of reclaimed support with a stop 1 structure below and partials at 1 and 2 times risk with a trail under higher lows. Then execute as written. The evening ritual turns experience into rules. Close the live platform at your stop time, even if you feel there is one more chance, then open your journal and your tracker. For each trade of the day, record the setup label from your playbook, the structure context, the confluence elements, the momentum note, the entry, stop, and targets that you planned before entry, and the final result in risk units. Score your compliance for each trade with a simple yes or no on whether you followed each rule. Write one sentence about the lesson you would pay to remember. Take 2 screenshots for each trade, one at entry with your marks and one at exit with notes, and file them in a folder named by date and setup so you can find them during reviews. If you broke a rule, design a constraint for tomorrow that makes that break harder. That could be a smaller size for the next session, a narrower watch list, or a ban on trading during the first 15 minutes after the open. If you followed rules and the trade still lost, acknowledge that this is how probability works and log it as a clean loss. Finish the day by planning tomorrow in 1 or 2 sentences. What market conditions will you favor, what will you avoid, and what one behavior will you aim to repeat? Shut down screens on time, stretch for a few minutes, and set a bedtime that protects sleep because fatigue lowers discipline. Routine is not a cage. It is the scaffolding that carries judgment from one day to the next, so your edge compounds in the calendar rather than evaporating in a single burst of emotion. Risk is not a shield you hide behind. It is an offensive tool that lets you press when conditions are right and survive when they are not. Start with a simple law. Risk on any single trade stays at 1% of account equity or less. The number is small on purpose because strings of losses happen to every method, and your job is to keep the account and the mind stable enough to continue. You size positions from the protective stop distance rather than from hope. Measure the distance from planned entry to the structure-based stop in points or pips or dollars, divide your 1% risk by that distance, and you get a share or contract count that fits the plan. If the count is too small to matter, the market is telling you the setup is not worth it at that location. Add a daily loss cap that ends the session before tilt begins. Choose a fixed number of risk units, such as 2 or 3 full stops. When that line is crossed, you stop trading for the day. You are not surrendering. You are preserving your ability to execute tomorrow with a clear head. Many traders recover a loss by trying to earn it back right away. Professionals recover losses by preventing tilt and returning when the edge is present again. Use a triple-layer protection system so bad trades end quickly and marginal trades do not linger. The hard stop ends the idea when the market proves you wrong at a specific level. The time stop ends the idea when price fails to move as expected within a window that fits your setup. If a retest entry has not triggered within your preset time, or if a position sits unchanged through the window, you cancel and reset. The correlation stop protects you from hidden concentration. If you are long a tech name and you plan to add a position in an index future that moves with it, you treat them as one cluster. If the cluster exposure reaches your limit, you cut size or pass on the second idea. In practice, this prevents days where 3 highly related positions all fail together and create a large drawdown. When a drawdown appears, you switch to recovery mode that is defined before the pain arrives. Step downsize to half risk after a sequence of stops such as 3 in a row or 3 within one day. Freeze any new rule changes until you complete a sample of 10 trades executed by the existing plan. Raise the bar for new entries by requiring clearer confluence or better reward to risk. Add a simple requalification test to return to normal size, such as 2 compliant trades that reach at least 1 times risk, or a full sample with clean execution even if the net result is small. This approach turns a slide into a training block rather than an identity crisis. Protect against rare violent moves with black swan rules. Respect scheduled event risk. If a major release or earnings report lands inside your usual entry window, you either stand aside until the first bars print, or you trade only with very defined retests and smaller size. Avoid holding highly leveraged positions through unknown news when you do not have a reason to accept the gap risk. Consider position limits per instrument and per theme so a single shock cannot harm the account beyond your plan. Some traders also keep a small hedge, such as cash or an offsetting position in a related market when exposure is heavy. The point is not to be clever. The point is to ensure that one surprise cannot erase weeks of steady execution. Volatility adjustment makes your risk math robust. When the market is quiet, your stops are naturally smaller and your position size increases. When the market is wild, your measured stop distance expands and your position size shrinks automatically. You can formalize this by referencing average true range on your time frame, so stop placement respects normal noise rather than fear. This keeps your reward to risk realistic and prevents the small stop large size trap that looks good on paper and fails in motion. Write if-then statements into your plan so the rules trigger without debate. If the session hits the daily loss cap, then close the platform. If 3 stops occur in sequence, then cut size by half and complete a 10-trade sample before any size increase. If a position is open into a scheduled event, then exit or reduce to a token size unless the playbook specifically allows holding through. If 2 open trades are highly correlated, then treat them as one and respect the combined risk limit. If a trade goes nowhere within the defined time window, then exit and log it as a non-event rather than waiting for hope. Examples make these ideas concrete. A currency pair breaks support on strong momentum and you short the first retest with a stop above the lower high. The move stalls and touches your stop. That is 1 unit of risk gone. 2 more small stops happen later as the range chops. You are now at 3 units down for the day and you close the platform even though attempting setup forms. The next morning, you return with half size and a calm plan. On a different day, you are long a chip stock while the index future and a second chip name flash entries. You treat them as one tech cluster. You take the index future at a small size and skip the second stock because the combined exposure would breach your cluster limit. Later, a news release spikes both and the first position is stopped for 1 unit while the second small position breaks even. The discipline avoided a 3-unit hit. In another case, a crypto pair makes a huge overnight gap. You resist the urge to chase the open. You let the first 2 5-minute bars print, confirm that the move lacks structure alignment on the higher time frame, and you pass. Hours later, a clean retest forms with a defined stop and 2-to-1 potential. You take it with normal size and execute the exit plan. The day ends green not because you predicted anything, but because risk was treated as a weapon that shapes behavior. When you frame risk as aggressive offense, you free your attention. You know the worst that can happen on any trade and on any day. You know how you will respond to sequences both good and bad. You allow strong opportunities to speak with size, and you prevent weak moments from expanded into damage. Over time, this steadiness compounds. The curve is not a straight line, but it bends upward because the downside is tamed and the upside is allowed to breathe. Patience is not the absence of action. It is the choice to act only when the odds are aligned and the path is clear. Most of your profit will come from fewer, better trades, while most of your stress will come from attempts to force the market to pay you on your schedule. The sitting statistics are simple. In a typical month, a handful of clean setups generate the bulk of the edge, and the rest of the motion exists to tempt you into paying spread, slippage, and attention. When you accept that reality, you stop asking how to trade more and start asking how to wait better. Waiting better is a skill you can train. Start with a timed patience drill at the open or at your usual entry window. Set a quiet timer for 15 minutes and promise yourself that you will not click during that period. Use the time to mark levels, watch how price respects or ignores them, and breathe. When the timer ends, you ask one question. Do I have structure, confluence, momentum, clean math, and emotional clearance? If not, you reset the timer and keep observing. This practice rewires the link between urgency and action so that a burst of motion triggers analysis instead of a chase. Build a one-trade challenge for a week. Allow yourself only 1 entry per session. You will become picky fast. You will choose locations where the stop is logical and the reward makes sense. You will let noise pass because you know that spending your 1 ticket on a half chance hurts more than waiting for the real thing. At the end of the week, review your notes. Most traders are surprised to see that fewer decisions produced steadier results and lower stress. Fill the waiting with work that compounds. Rehearse your entry sentence out loud. Update your higher time frame map. Log state scores every half hour. Take a short stand and stretch break to discharge restlessness so your body does not push you into a trade just to relieve pressure. If a scheduled event approaches, you plan your response in advance and you write it in 1 line so there is nothing to negotiate in the moment. Patience also governs exits. After the first partial fills, you let the plan work without babysitting each tick. You remind yourself that a healthy trend breathes and that a pullback to structure is not the market trying to hurt you. When your invalidation prints, you exit with no debate. When your target prints, you take it with no hesitation. You do not speed up because the screen is noisy, and you do not slow down because you are afraid to be wrong. You act on the plan you wrote when you were calm. Over time, this rhythm turns waiting into a competitive advantage. You conserve attention for high-quality decisions. Your emotions stay inside a narrow band, and the curve bends upward because you are no longer paying the tax that impatience demands. Information hygiene is the quiet edge that protects your attention from noise and your plan from other people's urgency. Begin by separating the world into 2 rooms. One room is research, the other is execution. Research happens off hours with a calm mind, where you study long-form material, backtest ideas, and write rules. Execution happens during your trading window, where you watch your map and act only by your checklist. Nothing from social feeds is allowed in the execution room. If a post or chat message appears while you trade, you log the idea for later review and you keep your hands off the mouse. Run a simple signal test before you let any source influence your research room. Ask whether the source shows a timestamped track record, whether they post entries and exits with clear reasons before the fact at least sometimes, whether they disclose risk and invalidation, whether they can explain losses without blame, and whether their method can be written as rules that a stranger could follow. If the answer to most of these is no, that source is entertainment, not input. Red flags include language of certainty, promises of fast wealth, calls without stops, dramatic claims tied to urgency, and constant new indicators with no sample review. Your default action with red flags is mute or unfollow. Protect attention like cash. Create a weekly audit that prunes your information diet. Open your follow list and ask for each voice a simple question. Did this input help me make one rule clearer or one decision cleaner this week? If not, remove it for now. Add a watch list for high-quality educators who teach process and test ideas in public. Limit yourself to a small number so your mind does not fragment. When a popular account posts a hot take, you do not let that take become your plan. You write their thesis in one plain sentence. You draw the higher time frame map yourself. You look for structure and confluence without reading the comments. You then convert the idea into your entry filter. If the setup does not give you a defined stop and at least 2-to-1 reward to risk, you label it interesting and pass. If it does, you place it on a separate queue for clean retests only. You never chase a call because the crowd is loud. You only trade an idea that survives your own filter. Groups and chats need rules as well. Set quiet hours when alerts are muted. Set a pre-market window where you may read a small set of prepared notes from trusted sources, then close the feed when the bell rings. If a group encourages revenge trading, oversized bets, or mocking clean passes, leave. If a group posts real education with charts that show entries, stops, and exits along with reasons, keep it on a short list and still route every idea through your playbook. Treat your feed like a garden. You pull weeds every week, you water the few plants that actually grow your edge, and you keep the gate closed during the hours when you need quiet to execute. Over time, the noise fades, your rules speak louder, and your decisions feel simpler because they are yours. Your mind needs a clean break from the flood of signals so you can hear your own rules again. Begin a short social detox that fits inside 1 week. On the first day, you turn off all market notifications and remove apps from the home screen. You write a single-sentence mission for the week and place it beside the monitor. On the second day, you unfollow hype accounts and mute group chats that push urgency or calls without stops. You keep a narrow list of calm educators who teach process, and you promise to review them only outside market hours. On the third day, you design quiet windows during your trading session. Feeds stay closed from the open until your planned stop time. If an idea arrives from outside during that window, you park it in a note and return to the chart after hours. On the fourth day, you rebuild your watch list from your circle of competence. Remove names that are there only because they trend on social media. Keep instruments that match your setups and timeframes. On the fifth day, you draft a one-page research flow you can repeat every weekend. Study long-form material, test one rule with a small sample, and write any change as a clear if-then statement. On the sixth day, you organize your screen so the chart and your journal are the only things visible during execution. Close browsers and hide anything that blinks. On the seventh day, you reflect on the difference in your state. Note where focus improved, where cravings showed up, and what guardrails helped most. Keep the best constraints and make them permanent. Now you build a fortress of inputs that supports your method instead of scattering it. Decide when research happens and when execution happens, and never mix the two rooms. Pick a small number of sources that show time-stamped reasoning and honest debriefs. Save ideas to a queue and process them later through your own filter. Write a simple engagement rule for any community you keep. No revenge talk, no oversized bets, no mocking clean passes. Share plans with entries, stops, and reasons when you can, and ignore posts that do not meet that standard. Protect your morning with a map-first routine. Protect your session with silence. Protect your evening with a short review and a plan for tomorrow. With a cleaner feed and firm boundaries, you trade fewer other people's stories and more of your own playbook. Over time, that quiet becomes an edge. There will be days when the screen dents your confidence and the account takes a clean hit. The Phoenix Protocol is how you stop the slide, repair the system, and return with clarity. It starts with a full stop. When a sequence of losses or a sharp drawdown appears, you end new risk for the day and you step away from the platform. You write a short entry in the journal that states what happened in plain words, and you mark the time you will return. This is not defeat. It is the decision to break the loop that turns pain into tilt. Next comes damage assessment. You open the tracker and review only facts. Which setups were taken? Did each one meet structure, confluence, momentum, math, and emotional clearance? Were stops placed where the idea is proven wrong? Did you respect the daily loss cap? You tag each trade as compliant or non-compliant. Clean losses are tuition and stay on the page without drama. Rule breaks are flagged for correction. You do not rewrite your method in this step. You separate process from outcome, and you name the exact rule that failed if one did. Then you reset state. You run a breath drill, you move the body, you get a glass of water, and you step outside for light and distance from screens. You close social feeds and you let the nervous system settle. When the emotional charge falls, you write a one-sentence plan for the next session that includes your stop time and your reduced risk level. Paper trading is the bridge that restores execution without financial pressure. For the next block of practice, you run your full checklist on live moving charts, but you click on a simulator. You log each simulated trade with the same fields as real trades. You care about behavior more than profit. When you can deliver a small sample with high compliance, you move to real positions at reduced size. The reduced size return is predefined, so there is no debate. You trade at half risk until you complete a set number of compliant trades or reach a small positive result measured in risk units. Only then do you step back to normal size. If a fresh sequence of stops appears, you return to half risk and restart the sample. The rule is simple. Size follows compliance. Confidence follows evidence. The psychological rebuild continues in the background. You replace the story of "I must win back losses" with the identity of "I run my process well." You celebrate clean passes and clean exits as much as profits. You reread your circle of competence and trim your watch list if it bloated. You plan your next review day and you keep the routine. The Phoenix Protocol does not chase relief. It builds it by proving to yourself that your decisions are sound again. Joy of missing out is the moment you notice that passing on a trade protected capital and attention and you feel good about it on purpose. Most traders only celebrate wins they took. Professionals also celebrate the clean wins they skipped. You train this by building a miss list. Each session, you log 1 or 2 clear passes that matched your playbook rules for saying no. You write the setup you avoided, the reason it failed your filter, and what loss or stress you likely saved. When a pass would have lost, you record the hypothetical risk unit you kept. When a pass would have won, you record that you kept your plan intact rather than chase outside your edge. This practice removes the sting from not being in every move and replaces it with the satisfaction of being selective. Add a simple celebration ritual so the brain links restraint with reward. When your rules trigger a pass and the idea is skipped, you speak one sentence out loud. "I honored my filter and protected my edge." Stand up, take one slow breath, and smile with your eyes for a second. It sounds small, but it teaches the reward engine to release a little dopamine for process, not just outcome. Over time, the body begins to feel good when you wait for A+ conditions and to feel uneasy when you consider breaking rules, which is exactly the tilt you want in your favor. Use a reframe formula whenever fear of missing out shows up. You say the observation, state the rule, and link it to equity. The observation sounds like, "This idea is moving fast without me." The rule sounds like, "I only take entries with structure, confluence, momentum, clean math, and emotional clearance." The equity link sounds like, "Passing here saves a likely stop or a churn that taxes my daily risk cap." This turns an emotional tug into a clear sentence that points at your account rather than at your craving. Run a weekly miss audit to prove the value of JOMO with numbers. Open your miss list and tag the passes that would have produced a stop, the passes that would have produced a scratch, and the passes that would have been wins but outside your method. Estimate the net risk unit saved and the stress avoided. Then compare that to the wins you actually took that met your criteria. The usual pattern is obvious. Good passes keep the drawdown shallow and free your attention for the trades that pay. Bad passes shrink when your filter is tight and your routine is strong. Seeing the math turns JOMO from a slogan into a habit. Finally, give JOMO a physical anchor in your day. When the session ends or your daily loss cap is reached, you close the platform and do something that marks a clean finish. Walk to the kitchen, drink water, or step outside for light. The action signals the mind that waiting and stopping on time are wins to be repeated. With a miss list, a celebration ritual, a reframe formula, a weekly audit, and a daily close anchor, you turn missing a trade into a profitable behavior rather than a wound to be healed. Deep focus is a choice you design into your day with clear boundaries, not a mood you wait to arrive. Begin by setting a notification hierarchy that protects the session. During trading hours, all alerts are off except a small set you pre-program for price levels that match your plan. Your phone lives outside arm's reach or in another room on silent. Messaging apps stay closed. If a genuine emergency contact must reach you, whitelist a single channel and a single person and let everything else wait until after your stop time. Build sacred windows on the calendar. A pre-market window exists for mapping and a post-market window exists for review. Nothing interrupts execution between those windows. If a thought or idea appears mid-session, capture it in a quick note and return to the chart instead of opening a browser. Batch all communication after the close so the mind does not splinter. Tighten the physical, digital, and mental environment so attention has nothing to fight. Keep the desk clear, the chair comfortable, and the lighting steady. Use one clean chart layout you do not change on the fly. Hide browsers and feeds. Keep only the watch list, the chart, and your journal in view. Put a glass of water on the desk and a small timer you reset every 45 minutes for a stand and stretch break so restlessness does not masquerade as a trade. If noise is a problem, wear earplugs or play soft neutral sound. Create a visible Do Not Disturb card for housemates during your window. Use a single task protocol when a setup is building. Say the plan in one sentence, place the order, and watch the price action that matters for the next decision. If you catch yourself alt-tabbing, you stand up, take one breath, and sit back down with hands off the mouse until the next checklist item is present. When the trade is done, you log it before you open any new window. Follow a simple eye reset to prevent tunnel vision. Every 20 minutes, look at something 20 feet away for 20 seconds. When stress rises, run one slow 4-count breath cycle and return to neutral. Close the session with a shutdown ritual that seals the boundary. Save charts, write the lesson you would pay to remember, plan the first 3 actions for tomorrow, and power the screens off. Leave the room for 5 minutes before you do anything else. The action tells your nervous system that the window is closed and your rules held. Over days, these boundaries turn focus into a habit rather than a hope, and the quiet you build becomes an advantage you can rely on.